two types of trading systems, unbiased trades here, and I want to go over what are the two types that make up most trading setups nowadays that you'll see traders trade either in the small cap space or maybe even futures. Also, mainly this video is going over my experience with these two types and how I've incorporated them or stopped using them. Now, trend or reversion. Trend following systems are designed around the idea to capture a trend in the same direction in a particular market or stock. These are usually advertised to newer traders as they can be easier to see with the use of technical analysis. A mean reversion system is designed to take moves from extremes in a stock/market price, looking for the price to revert back to the medium, such as VWAP or a predicted price of value. This type of system is normally located in the extended or overbought markets or even range bound markets. I have seen, some good profitable strategies in there with mean reversion. Now, both of these are the foundation for most setups traders will trade. There are more niche setups such as arbitrage, or you'll see them around on Twitter. But I want you mainly to think about what one do you think your setup falls into, and how you could maybe incorporate some lessons I've learned from these two types into your own trading. Now, trend systems. I'm first going to be going over how I've used these in developing a future system. However, I will discuss small caps later on with these two foundations in mind. As mentioned before, we can either go with a trend or mean reversion system. My first attempt at futures was simply using EMAs, as they had historically been quite profitable in the ES market. However, they were absolutely ruined on choppy days and excelled in trend days. This is quite obvious to most, simply because EMAs, when it's on a trending day, the market will bounce off them and then continue higher or continue lower. But in choppy days, the EMA will be in between the price and you'll be getting really bad entry and exit signals. Now, I tried a few approaches to improve its performance on choppy days. The first was volatility. I assumed, because low volatility can be associated with choppy days, that if I used an average true range filter on my setup, I could prevent trades from being placed on days with less than free ATR. This did help, but it significantly reduced the amount of sample trades and overall profits. That I discovered ATR really wasn't the approach, and it could still be profitable if I used it on a higher time frame, but I personally didn't like the amount of trades it was giving out. Now, my second attempt was to include a confirmation EMA, which means that if my system created an entry trigger, it would wait for price to break above, let's say, a 9 EMA. Now, this improved the setup's performance while also lowering the drawdown. This did, however, overall, as I mentioned, increase the performance, but it didn't really alleviate the choppy market days. It simply helped make my setup better and more efficient by taking less impulsive kind of like entries, I guess you could say. Now, I eventually gave up on developing a trend following strategy since I couldn't discover an adequate gauge for identifying whether the market was choppy or not, and I didn't like how discretionary I would have to be in identifying it. I eventually figure out a better approach, but I opted to go with my new setup idea, which is based on level generation and built on mean reversion. In conclusion, trend following systems can produce amazing results, but you'll need to be effective in determining if a stock or market is suitable for a trend following system that particular day. Now, can this be done with the naked eye? Yes. But can you backtest the naked eye? I would argue that you probably couldn't, unless you did it manually every day for, like 4 months or something. However, that is possible. So if you want to do that, you can do that. Now, mean reversion. Mean reversion was my next stop because it doesn't suffer from chop, because it's based on the concept of overextension and overbought, which means it should be taking an entry either at the highs or lows for that time period. This is why I started to explore this type of setup, as I wanted to see if I was better at solving issues that came along with a mean reversion strat compared to a trend following strat. Now, first you have to establish what is overextended and what is overbought for you. How will you quantify it? And personally, the route I chose was RSI. I thought it was very straightforward, and it was easy to backtest, and it was easy to test the idea of it on some data in Python. Now, before I implemented RSI, I didn't want to just take a short or long based on the RSI, so I tried to employ a level creation idea that generates levels based on two inputs and then creates around 14 levels in that price range with two standard deviations. Now, this is definitely not needed for your own idea. However, I do suggest a combination of RSI with something for a mean reversion strategy in the futures markets, as futures more often than not are way more noisy, so you'll need more filters compared to small caps, for it, let's say. Now, this offered some excellent early testing results, but after investigating how many losers it could take in a sequence, I learned that trend days were its nemesis. The irony isn't lost on me. Now, fortunately, from my personal testing, there are some simpler solutions to fix this. One is to limit how many losers can be allowed in a row before it has to take a trade in the opposite direction. Additionally, you can make the price need to cross above a level or an EMA, for example, before the entry trigger is allowed. This stops days when the price is just falling and will mean you'll have a less impact on your P&L, but overall your P&L and number of trades may decrease due to the additional criteria. Overall, I do recommend mean reversion to many traders, as if you're naturally a contrarian, it can be a very profitable foundation to base a setup on. For small caps, as I promised before, I'll talk about how these two types of foundations apply to small caps. Now, the most obvious is mean reversion. We're all doing some type of mean reversion short in small caps. This is basically because small cap price action can be extremely volatile due to the mixture of liquidity and severe illiquid times. This means we can get extreme spikes with a combination of small floats, which means we can get huge moves and be able to short them with very good R. So for small caps, I would choose a mean reversion strategy because it is easy to comprehend, as most small cap companies do not average to trend higher due to having less value fundamentally as a company. Second, the mean reversion in small caps can be measured using overall percentage up from the median value of the past 3 months or simply the previous close. You do need to be cautious to make sure you're checking if the company's fundamentals do change. For example, I can't tell you what news equals higher fundamental value. However, I can say if anything has phase 3 or cancer, it can be a massive red flag to short because fundamentally the price of that company has maybe changed. Mean reversion in small caps can also take various forms. For example, you can utilize volume profile to help identify levels of interest that you might want to short, or you could use EMAs plus volume to detect if a stock has overextended and now finally gone onto a potential backside. Or a great one is using Fibonacci levels as a potential entry point. Shout out to Justin Flynn for that idea. However, you can apply a similar strategy to what is described in my 4-part series of my setup, which uses data and statistics to determine medium averages that help you find potential points to enter to short, as it historically provides an edge that will show you that the stock will most likely move lower. You should also ensure that whatever your strategy foundation is, that your created criteria has statistical edge to back it up. As a general guideline, you should never trade anything where you have no understanding of what the chances are, meaning you need to know the data behind your decisions. Now, in my opinion, there is no perfect risk management that works for both or either of these foundations. However, risk management does have relatively simple core essential concepts, such as a maximum loss on the day or not putting your entire account on one trade. However, my general opinion is for trend following systems, particularly in futures, a trailing stop with a potential break even stop trigger, if you are up a certain amount of points, can be quite advantageous. This is a semi controversial subject because Trader Dante absolutely hates this idea, but I do believe that with certain setups, it can be very advantageous if you test it. Additionally, trend systems can incorporate position building, where you build a position over intraday, which can provide more stable profits and less drawdown. Now, for mean reversion, I would suggest a tighter stop for greater R for range bound mean reversion systems. However, in the case of small caps, a slightly larger stop can be quite beneficial in terms of long term account growth. This can be customized to the trader, but make sure to test multiple risk methods on a given setup to determine which one performs best. Lastly, for position sizing, starter positions are common in mean reversion strategies if you have more general slash loose entry criteria. However, I would recommend, if possible, a one in, one out position sizing solution. Now, I'm still holding a free call. You can book up until 2023. However, if you can only do after 2023, that's totally fine as long as you book before 2023. But I hope to talk to you and help you on any of your ideas, either becoming more systematic or if you need help in Excel or backtesting, etc. Thank you for watching, and if you enjoyed, please like and share with anyone that might be interested.